Yo, what's up everyone? It's Dennis Kantarevich, and let's be real. Nobody likes paying taxes. We work hard for our money, and seeing a big chunk of it disappear every year can be frustrating, right? But what if I told you that you could legally reduce your tax bill, potentially by thousands of dollars? That's right. In this video, we're diving deep into some smart tax hacks that can help you keep more of your hard-earned cash in your pocket in 2025 and beyond. Make sure you stick around until the end, because tip number 5 is a strategy that even the wealthiest individuals use to save millions. Let's get started. The first and arguably easiest way to reduce your tax burden is to absolutely maximize your retirement contributions. Now, I know what you might be thinking. Graham, isn't this basic? And you know what? You're right, it is. But that's because it works. Contributing to your retirement account, whether it's a 401k, IRA, or superannuation for my Aussie viewers, is like hitting the tax savings jackpot. In the US, for 2025, you can contribute up to $23,000 to your 401k or IRA. And this money grows tax deferred. That means you don't pay taxes on it until you withdraw it in retirement, and hopefully by then you'll be in a lower tax bracket. And if you're 50 or older, you get a catch-up contribution limit, which means even more tax savings. For my Australian friends, your superannuation system is fantastic for tax savings. You can contribute up to $27,500 per year, and the best part is, these contributions come directly out of your paycheck before taxes are even calculated. That's right. It's like the money never existed in the eyes of the tax man. But here's the thing, guys. Maximizing your retirement contributions isn't just about saving on taxes today. It's about setting yourself up for a comfortable and financially secure future. Compound interest is a powerful force, and the sooner you start investing, the more time your money has to grow. Now, let's talk about one of my favorite ways to save on taxes: starting a business. I'm not saying you need to quit your job tomorrow and become the next Elon Musk, but even a small side hustle can unlock a treasure chest of tax deductions that employees just don't have access to. Think about it. When you're self-employed, you become a business owner, and suddenly, everyday expenses can become potential tax write-offs. That home office you've been using, deductible. Your internet bill, deductible. Business trips, marketing expenses. Even a portion of your rent or mortgage if you're running your business from home, all potentially deductible. And the best part is, starting a side hustle has never been easier. Whether you're passionate about photography, graphic design, writing, or even just walking dogs, there's a market for your skills online. Platforms like Etsy, Upwork, and Fiverr make it incredibly easy to connect with potential customers and start generating income. But here's the real kicker. Running a business allows you to deduct expenses from your income, which means you're only taxed on your profit. So let's say you make $10,000 from your side hustle, but you have $4,000 in legitimate business expenses. You're only going to be taxed on the remaining $6,000, not the full amount. That's huge. Let's talk about real estate, one of the most powerful wealth-building tools, and you guessed it, a tax-saving powerhouse. Now, I'm not just talking about buying a rental property, although that's a fantastic option. I'm talking about understanding the tax benefits that come with real estate ownership, period. First and foremost, you've got depreciation. Depreciation is a beautiful thing because it allows you to deduct a portion of your property's value each year to account for wear and tear, even though the property itself is likely appreciating in value. It's like getting a discount on your taxes just for owning the property. Then there's the mortgage interest deduction. While this has been limited in recent years, it can still save you a significant amount of money, especially in the early years of your mortgage. And don't forget about property taxes, insurance premiums, maintenance costs, and even the cost of advertising for tenants. All of these can be deducted from your rental income. But here's where it gets really interesting. The tax code is structured in a way that allows you to use real estate losses to offset other income. Now, I'm not talking about actual losses here, but rather paper losses created through depreciation and other deductions. For example, let's say you have a rental property that generates $10,000 in rental income, but after all your expenses and depreciation, you have a paper loss of $5,000. You can use that $5,000 loss to offset other income, such as your salary or capital gains, potentially lowering your overall tax bill. Now, let's move on to something that's even better than a tax deduction tax credit. See, a tax deduction reduces your taxable income, but a tax credit directly reduces the amount of taxes you owe, dollar for dollar. It's like getting free money from the government, and who doesn't love free money? One of the most valuable tax credits available is the Earned Income Tax Credit, or EITC. This credit is designed to help low to moderate income working individuals and families, and it can be worth thousands of dollars. In fact, for 2025, the EITC can be worth up to $7,430 for families with 3 or more qualifying children. Then there's the Child Tax Credit, or CTC, which provides a tax break for families with qualifying children. In 2025, the CTC is worth up to $3,600 per child under the age of 17. And the best part is it's fully refundable, meaning you can receive the credit even if you don't owe any taxes. And for those of you looking to make a positive impact on the environment while saving money, there's the Electric Vehicle Tax Credit. This credit can be worth up to $7,500 for the purchase of a new electric vehicle, making it more affordable to switch to a greener mode of transportation. But here's the thing, guys. Tax credits are constantly changing, so it's crucial to stay informed and make sure you're claiming all the credits you're eligible for. The IRS website is a great resource for this, and you can also consult with a qualified tax professional to ensure you're not leaving any money on the table. All right, guys, we've arrived at the final and arguably most powerful tax hack on this list, strategic relocation. Now, before you click away thinking this doesn't apply to you, hear me out. I know it sounds extreme, but it's a strategy that many high net worth individuals and even corporations use to legally reduce their tax burden. Let's start with the US. Did you know that 7 states have no state income tax whatsoever? That's right, 0. These states include Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, and Wyoming. Now, I'm not saying you need to pack your bags and move to the middle of the desert, but if you're living in a high-tax state like California or New York, relocating to a more tax-friendly state could potentially save you thousands of dollars each year. But it gets even more interesting when you start looking at international options. There are countries around the world that are essentially tax havens, offering incredibly low or even zero income tax rates to attract wealthy individuals and businesses. For example, the United Arab Emirates, particularly Dubai, is known for its tax-friendly policies. There's no income tax, no property tax, and no capital gains tax. Singapore is another popular choice, with a territorial tax system that only taxes income earned within the country. And then there's Monaco, a playground for the ultra-wealthy with no income tax, no wealth tax, and no inheritance tax. Now, I understand that relocating to another country is a major life decision, and it's not something to be taken lightly, but it's important to understand that you have options. And if you're serious about minimizing your tax burden, exploring these options might be worth considering. But there you have it, guys. 5 powerful tax hacks that can help you keep more of your hard-earned money in your pocket. Remember, paying taxes is a part of life, but it doesn't have to be painful. By implementing these strategies and staying informed about changes in the tax code, you can take control of your finances and achieve your financial goals faster. Now, I want to hear from you. What are your go-to tax-saving strategies? Have you tried any of the hacks I shared in this video? Let me know in the comments below. And if you found this video helpful, don't forget to give it a thumbs up and subscribe to the channel for more smart financial tips. Now that you know how to reduce your taxes legally, it's time to take action. Don't leave free money on the table. If you want more financial hacks, subscribe to our channel and turn on notifications so you never miss a video.